I wanted to do another video on bonds. Bonds have been driving a lot of the volatility that we're seeing in the markets, and a lot of people tend to be lower risk investors, so they're feeling that a lot more than they may have done in the past. So I think it's really important that you understand how bonds work, because it's very different than stocks. So a stock is an ownership in a company. A bond is when somebody lends that money to a company. And bonds and GICs, or term deposits, are actually very, very similar. Um, you're both lending money to an institution. It's both backed by that institution. Um, that you have the option to take regular interest payments from that product. So, for example, if you have a 5-year GIC that pays 5%, you can opt to have that money every single year, just like with a bond. Um, the biggest difference is that with a bond, you can sell that to somebody else before 5 years is up. With a GIC, however, you are locked in. You cannot access that money in the meantime. And that becomes very, very important when interest rates move. So the relationship between bonds and interest rates is, if the expected interest rate is higher, that's what the people demand from the market is higher, well then bond prices go down. Why? If you have a 5% bond and new companies are offering 10% bonds, why am I going to purchase your 5% bond when I can just go to the company and get 10% bonds? So that's how it works. When interest rates go up, bond prices come down, but the opposite is also true. When interest rates go down, bond prices go up, right? If you have a 5% bond and now the only thing people can get are 2% bonds, while your bond that's worth 5%, that's getting 5%, is worth a lot more. So you would sell it at what we call a premium. I would like to shift gears to look at the math side of things. And I've tried to simplify it a fair amount. So there's a few things that you need to know. First of all, a bond's value is calculated using the face value of the bond and the coupon payments that that bond provides, and expected interest rates, plus how long the bond is. So it takes all of that into consideration. It uses something you may be familiar with or may not be, but it's the time value equation. Is use a ton if you do business or accounting or anything like that. But it's equation you need a financial calculator to do it, or Excel. But yeah, so I'll kind of explain how it works. So we're going to say that this is a Bell bond, and this is why term deposits or GICs are so similar to bonds, and you'll see why. So the coupon payment, so that is the annual payment that Bell are offering or will provide, is 5%. The current rates, so the expected interest rate that current investors expect Bell to pay for this type of debt is 5%. The number of years is 5 years, and the face value is $1,000. So this is like you walking into the branch, into a bank, and paying 5% for a 5-year GIC. And that's it. Because interest rates, the bank will not give you a bond or a GIC based on other interest rates than the current ones. So you pay $1,000 for that. You get coupon payments of $250. At the end of the 5 years, you get $1,000 back, and the total you received is $1,250. You paid $1,000, you gain $250, 5% return. Pretty simple. Now, this is where bonds and GICs differ, is because with a GIC, remember, you cannot sell it, you cannot get rid of it once you've entered into that contract. With a bond, however, you can. You can have somebody else, Bell won't buy it back from you, but you can have somebody else buy it from you. So now, just as with the bank, you get current interest rates. Interest rates, let's say they go up. Let's say they go up to 8%. Notice what happens. Well, still 5%. The coupon payment, the interest payments do not change. The expected interest rate now, though, is 8%. So that's what bonds now, if you were to go to Bell today, they would pay 8% instead of 5%. Number of years, 5 years still, keep it simple. Face value, after 5 years, they'll still give you back $1,000. But what's the value of it today? The value of it today is $880. Why? Well, why would somebody be willing to settle for 5% when they can get 8%? So you have to give some of it up. So coupon payments, still $250 at the end of the 5 years. They'll still get back, whoever owns that bond now will get $1,000. They will receive $1,250. But what did they pay for it? Well, they paid $880. So there is a gain of $370. And surprise, surprise, what does that total return kind of equal? Well, it equals around what current interest rates are. And it's not 100% because that'd be me getting way further into math, but you get the idea. Now let's see, same bonds, but let's see the other way. Let's say we interest rates drop. Well, same thing. 5% coupon doesn't change. Interest rates, though, expected, and now 2%. Number of years, 5 years. Face value, $1,000. That's what they get back. Bond value today, though, $1,141. Why is it $1,141? Same principle applies. Yeah, the current interest rates are 2%. So that's what current investors get, 2%. You want to sell it. So what do they get back? Well, they get back exactly the same. They get back at the end of the maturity, they get back $1,000. They get their $250 back, but they paid $1,141 for it. So they had a total gain at the end of the day of $108.60. Guess what that return is very similar to? Their current expected return. And that's how bonds work. What you could do is not sell. You could just not sell, and then it doesn't matter. The fluctuations are irrelevant because it's only relevant if you sell. And just like a GIC, if you hold it to maturity, you get the money back. So yes, bond prices are down right now because interest rates have gone up. But the point is that if you hold them to maturity, then you get the principal back. And that's a key fundamental of bonds. You notice that the bond values today are not changing based on anything else but math. It's not unlike stocks. Stocks and bonds are very different. Stocks go up and down based on my thoughts of what that company is going to do, or the larger market or the economy or whatever. Bond values go up and down based on interest rates, based on the expected interest rate that I should be receiving for that bond. That's what dictates what I'm willing to buy that bond for. Or you could just not sell it. You could just be okay with the 5% return and you wait 5 years and you cash it out. But if you want to sell it, you can sell it. You could also end up here with 2% bonds. You can see how significant what has happened recently during COVID. Interest rates are really low, and now they're at about 7%. So that 5-year bond is now selling for, that's almost 20% below the value. 20% below the value because interest rates have jumped so high. You still get $1,100 back at the end of the day. You still have your $100 in coupon payments, but why would I be willing to pay for that? Pay that when I can get something so much higher? Because I can get 5% now. As you go, you can see like if you had bought the bond at 2%, at 4%, at 6%, and current interest rates are at 7%, you can see what they're all worth. And the same thing applies on the way down. If we have a coupon rate So oftentimes the coupon rate will be very close to what the current interest rates are expecting, right? Um, similar to GICs, there. And the same thing applies. So I hope that at least gives you some idea, diving a little bit deeper into the math behind it and why it works that way. If you do have any questions, always feel free to reach out and ask. And if you'd like to dive deeper into it, we certainly can. I didn't even touch on return calculations. That's why they're not. I want to keep it as simple as possible. But if you'd like to go through that, let me know. Anyway, that gives you a little bit of clarity, and I'll see you in the next one. Thank you.